let's dive right in.
Yeah, so have you ever looked at a market dashboard and just felt like, you're staring at the flight console of an airplane that is basically stalling out with like every single warning light flashing red?
Yeah, all at the exact same time.
Right. Usually there is a baseline logic to how asset classes move together, a rhythm. But today's session, well, it completely shattered that rhythm. We are talking about a brutal trading day defined by a massive gold rush, a dramatic tech sell-off, and this incredibly toxic cocktail of geopolitical fire mixed with a really hawkish reality check from the Federal Reserve.
I mean, it was a deeply punishing session for risk assets across the board. So our mission for this deep dive is to unpack the 24-hour cycle that just dragged the S&P 500 down to 7,316 and, simultaneously propelled gold past $4,100 an ounce.
Which is just wild to see.
It really is. We want to dissect the underlying fundamental logic driving these massive moves, because for anyone watching their screen today, this wasn't just random panic, right? There is a very clear mechanical repricing happening underneath the surface.
Exactly. And just as a quick reminder before we really get into the weeds, this deep dive is strictly for market context and discussion only. It is not personal investment advice or, a recommendation of any kind.
Definitely. So to truly understand the carnage of the U.S. trading session, we actually have to wind the clock back to the night before.
Right, which brings us to session 1. What set the stage before the U.S. session? Because you really cannot look at today's opening bell in a vacuum. Let's set the scene from Tuesday evening, July 28th.
Setting the scene.
At 6:13 p.m. Eastern Time, the Islamic Revolutionary Guard Corps fired ballistic missiles directly at a U.S. military base and command center in Jordan.
Fortunately, those were intercepted.
Yeah, thankfully. But the response was swift. Just 2 hours later, at 8:22 p.m. ET, the U.S. and Saudi Arabia responded with coordinated precision strikes in Iraq, specifically targeting Iran-backed militia headquarters.
Which, resulted in at least 20 casualties among the Popular Mobilization Forces, and that prompted immediate, credible threats of retaliation from those militias.
And here is where I want to push back a bit on how the market usually digests this kind of news.
Okay, how so?
Well, when these Middle Eastern conflicts flash across the terminal, traders have this bad habit of treating them like, unpredictable natural disasters, like a hurricane hitting the tape. The mentality is sort of, you can't predict it, so you just react when the wind starts blowing. But isn't that a really lazy way to price geopolitical risk?
It is incredibly lazy, and frankly, it is the wrong framework entirely. Treating these strikes like random acts of nature completely misses the underlying mechanics. If we apply a game-theoretic lens, this isn't random at all. We are watching calculated geopolitical brinkmanship. Iran and the Houthi forces are actively and systematically trying to squeeze maritime transit routes.
Basically to inflict enough economic pain to force the lifting of blockades.
Exactly. They're testing boundaries. They know that every single missile launch mechanically raises the risk premium on global shipping.
And they aren't just making threats, right? They are physically disrupting the supply chain.
Yeah.
You look at what the Houthis did next. They threatened to impose transit fees on all commercial shipping passing through the southern Red Sea.
Yeah.
But here is the fascinating detail. They explicitly exempted Chinese fleets.
Which is a massive geopolitical signal dividing global trade routes by political alignment.
Yeah.
And they followed up on those threats quickly. Wednesday morning at 11:42 a.m. ET, multiple drones struck a liquefied natural gas tanker at Egypt's Damietta port. Yeah, it caused a fire, and it forced a whole queue of tankers to immediately relocate. They are directly targeting the physical energy supply chain, which removes any buffer the market thought it had.
And the hard data proved exactly how thin that buffer really is. At 10:30 a.m. ET on Wednesday, the U.S. Energy Information Administration, the EIA, released their weekly report. And they reported a staggering 7.167 million barrel draw in U.S. crude oil inventories.
That is a massive number.
It really is. Just to give you some perspective on why that number is so shocking, it brings our 9 SPR stockpiles, meaning the oil we have outside of the government's emergency fund, to a 7-year low.
Wow, so the physical cushion is simply gone. When you see a draw of over 7 million barrels while critical maritime transit routes are literally under fire, the physical reality of the market changes instantly.
The reaction was violent. Brent crude rocketed over 7.9% to roughly $90.74 barrel. West Texas Intermediate closed at $84.60. But you have to view this explosion in energy costs alongside the persistent Section 301 trade tariffs we already have locked in on Chinese goods.
Right, it's all stacking up.
Exactly. We are dealing with multiplicative supply inflation. The costs of tariffs, rerouted shipping, and tight oil are all compounding on each other.
And while the physical world was grappling with oil and missiles, the digital world was suffering its own structural tremors before the U.S. even opened.
Yeah, the Taiwan weighted index completely collapsed, dropping 4.65%. We are already in the middle of this intensifying semiconductor downturn, but then nature actually did intervene here. A lower 5-intensity earthquake hit Japan.
Right, which forced TSMC to halt operations and inspect equipment at their Kumamoto fabrication plant.
Right.
And, you have to understand the mechanics of a semiconductor fab to grasp why a minor earthquake is such a major event. These facilities use photolithography machines that operate at nanometer precision. A tiny seismic tremor misaligns equipment that requires days, sometimes weeks, to recalibrate.
It just highlights the extreme fragility of the global chip supply chain. So basically, the U.S. equity market opened against a backdrop of incredibly tight oil, rapidly escalating regional wars, and highly fragile offline semiconductor plants. It was a powder keg?
Yes, it was.
So that wraps up our first session. Let's take a short break, and then we will transition right into the U.S. trading hours.
Welcome back. Let's dive into session 2. What moved markets during U.S. trading hours?
Well, the spark that really set off that powder keg came directly from the Federal Reserve. Right at 2 p.m. ET, the Fed released its policy announcement. They held the benchmark interest rate steady at 3.50 to 3.75%. But the absolute bombshell was the vote count. It was 9-3.
A three-way dissent. I mean, you rarely ever see that level of fracture on the committee. The Fed prides itself on consensus, but Hammack, Kashkari, and Logan all formally dissented, voting for an immediate 25 basis point rate hike.
A rate hike. Right now in the face of a slowing economy.
Exactly. That dissent signals severe internal alarm. And then, at 2:30 p.m. ET, Chair Kevin Warsh took the podium for his press conference. If anyone was looking for a dovish pivot, they were deeply disappointed.
Oh, yeah.
He highlighted the impressive resilience of the economy and explicitly stated that if underlying inflation moves higher, he is inclined to tighten policy. He is looking at that oil tape, he is looking at the compounding tariffs, and he is telling the market that rate hikes are very much back on the table.
But, let me challenge you on the market's initial reaction here, because if you were watching the charts at 2:30 p.m., it was incredibly confusing. During the first few minutes of Warsh's hawkish press conference, the S&P 500 actually rose 0.6%.
Right.
I mean, why on earth would the market rally when the Fed chair is threatening to hike rates into a slowdown? Was it already priced in or just ignoring him?
It wasn't ignoring him. It was a pure algorithmic reflex. We call it the bad news as a Fed cut chicken gang dynamic. For the last decade, markets have been trained to believe that if geopolitical chaos erupts and growth slows, well, the Fed will always ride to the rescue with rate cuts.
Hoping they'll blink first.
Exactly. The initial pop was the market assuming Warsh was bluffing, betting that the Fed would eventually capitulate to save the economy.
But that logic inverted almost instantly.
Because the reality of central bank paralysis under supply-driven stagflation suddenly clicked. The market realized that the Fed is in a straitjacket. If they try to free their arms and cut rates to save growth, oil goes higher, the dollar weakens, and inflation gets significantly worse.
Right.
But if they pull the straps tighter and hike rates, they crush consumer demand and trigger a deep recession. They are completely trapped by supply shocks that they cannot control with interest rates.
And once traders realized the Fed was in that straitjacket, the carnage started. We saw one of the most violent intraday reversals of the year. Following that brief illusion of a rally, the S&P 500 completely collapsed, closing down 1.52% at 7,316.15. The tech-heavy NASDAQ plunged 1.74% to end at 24,442.984.
And fear just ripped through the options market. The VIX spiked to 20.66.
Yeah.
While equities were bleeding, the flight to safety was historic. Gold was the undisputed winner of the session. It staged a spectacular run, peaking at $4,166.80 before closing at $4,150.40.
Which is an aggressive, undeniable signal from institutional money.
Exactly. They are buying gold because it acts as both a safe haven from geopolitical chaos and a hedge against the persistent inflation the Fed is struggling to contain. At the same time, the U.S. dollar index weakened to 100.85, and 30-year Treasury futures fell sharply, which means long-term yields are rising.
So we essentially witnessed a harsh repricing of risk assets as the reality of a hawkish, completely paralyzed Fed finally set in. Let's take a brief break, and then we'll move into the post-market corporate events.
Sounds good.
All right, we are back. Let's jump into session 3. Corporate events recap and what to watch next. Because the bleeding didn't stop at the closing bell. If anything, the corporate earnings released after hours poured gasoline on the fire.
They really did. Right at 4 p.m. ET, the numbers dropped for Microsoft, Meta, and Qualcomm. And the absolute jaw-dropper of the group came from Microsoft. They revealed that their future uncommenced lease commitments surged from $197 billion to an astounding $329 billion.
Let's slow down and really unpack that phrase, uncommenced lease commitments. This means Microsoft is legally on the hook for $329 billion worth of data centers, land, and power infrastructure that haven't even started operating yet.
Right, they aren't generating a single dime of revenue yet.
Exactly. The financial liability is locked in on the balance sheet. To put $329 billion in perspective, that is larger than the entire gross domestic product of a country like New Zealand just in pending server leases.
It is a staggering figure, and it highlights the terrifying reality of the $700 billion AI supercycle. We are watching AI capex act as a self-defeating valuation loop. These massive leases act as a physical anchor on their future free cash flow.
And to justify their current stock multiples, they demand flawless monetization tomorrow.
Exactly.
And right now, the spending is heavily front-loaded while the revenue is, well, just a promise. You saw Meta's Mark Zuckerberg outlining their plans to eventually monetize AI via consumer subscriptions and a business-in-a-box service model. But the market is starting to realize that selling software subscriptions might not be enough to cover a $329 billion infrastructure tap.
Especially when you look at the health of the consumer. It's not just the enterprise infrastructure side feeling the pressure. The consumer hardware side is flashing warning signs, too. Look at the announcement from Apple on July 28.
Right, ditching their upgrade program.
Exactly. They are completely ditching their classic in-house iPhone upgrade program and shifting to a lease model partnered with the buy now, pay later company Klarna.
That tells you everything you need to know about the state of the consumer in a high-rate environment. When the undisputed hardware king of the world has to get incredibly creative with consumer financing just to maintain demand for its phones, you know the average buyer is tapped out.
It is a profound shift. The cost of living is so high and credit is so tight that even buying a phone requires a structured lease agreement now. By the way, if today's market recap has you wanting to crawl under a rock, just make sure it's gold-plated to catch that safe haven bid.
I love that.
Seriously, though, between the Fed's family fight over rates, drone attacks on LNG terminals, and tech giants signing over $329 billion in AI leases, our portfolios are starting to look less like retirement plans and more like high-budget sci-fi disaster movies.
At this rate, the only intelligence we can afford is artificial, and the only positive yield is the premium we are paying at the gas pump.
Exactly. But look on the bright side. If you held onto your cash today, you officially outperformed the Nasdaq's brutal slide. Let's close the books, ignore the brokerage alerts for the night, and hope tomorrow comes with a lot less geopolitical drama.
I highly recommend turning off those push notifications. But as we look ahead, here's what you need to watch over the next 24 hours, going into Thursday, July 30th. At 8:30 a.m. ET, we have a massive economic data dump. The BEA will release the Q2 advanced GDP, June personal income, and the PCE inflation metric, plus weekly initial jobless claims.
Big morning.
Huge. Then at 11:30 a.m. ET, the Dallas Fed weekly economic index drops, giving us a real-time pulse on growth. And finally, at 1 p.m. ET, the Treasury is holding a 5-year note auction, which will severely test the market's appetite for holding government debt after today's hawkish Fed commentary.
All right, let's pivot into our 2-minute bonus